Life Section 3 is the application, underwriting, and policy delivery. The underwriter works for your insurance company in their home office, and their job is to professionally assess the risk. The application is the main source of underwriting. The application must be signed by the applicant and the producer. The producer is you're the frontline underwriter. If the client says they don't smoke but they're sitting with their cigarettes, you might want to ask them, whose are those? You represent your insurance company after all, so you are the frontline underwriter. If the owner of the policy is someone other than the insured and the insurance is being sold to an adult proposed insured, not a minor child, you do need the applicant to sign as well. So if the owner and the insured are not the same person, which is sometimes the case, I buy insurance on Bruce, my husband. He would need to sign the application as well. You can't just go buy insurance on someone else without their knowledge. It'd be kind of creepy. You'd be worried. Who's coming after me, right? No. You need the signature of every proposed adult insured. Children, of course, if you're buying insurance on a child, children cannot legally sign anything anyway. So the applicant signs it, the owner signs it if the owner is someone other than the applicant, and the producer signs the application. The answers to the questions on the application, I said this already, are what we call representations, the truth to the best of your knowledge. Anytime a change is made to an application, it must be initialed by the applicant. So one time I was buying insurance and Bruce was buying insurance, and then we signed our applications, or so we thought, and then the producer realized that I had signed his application and he had signed mine. So we had to go through and initial all the changes, like I am a female, not a male, and it was just a big mess. But in order for a change on an application to be valid, it must be initialed by the applicant. As the producer, oftentimes you will help your clients fill out your application. If you asked your client if they had a heart condition and they said yes, but you said no because you really want to make your commission, you have made what is called a misrepresentation, which is against the law in all 50 states. So do not make a false statement on the application. I mentioned if the insurance company accepts an incomplete application, which really rarely would they ever do, but if they did, they issued a policy based upon an incomplete application. The insurance company is waiving their right to contest a claim related to whatever was left blank. It's called the doctrine of waiver and estoppel. They're giving up their rights under the incontestability clause to contest a claim that's related to those blank areas of the application. We know that we ask for representations on the application, the truth to the best of your knowledge. Failure to tell the truth is a misrepresentation. Now, tie that into incontestability. If someone makes a misrepresentation and dies in the first 2 years of the policy, the insurance company is going to investigate the claim. If the misrepresentation was material, which means would have mattered in underwriting, then they will deny the claim. You're not going to get a refund of your premiums if you committed fraud. Basically, that person committed fraud. If the misrepresentation wasn't a big deal, like they lied about their middle name because they really hate it, who cares? Nobody cares. So what about if they lied about their age? Are they going to contest the claim? No. Misstatement of age allows the insurance company to adjust the face amount to whatever the premium paid at the correct age would have purchased. Lying about an immaterial fact has no effect on the policy. Lying about a material fact, if discovered in the first 2 years, does have the effect of voiding the policy. After 2 years, the person is covered. The liars prayed for 2 years and then they're covered. Doesn't matter. It's kind of a weird rule. Warranties are guarantees of truth. We never ask for warranties in life or health insurance. No one can guarantee their health. Concealment is failure to disclose a material fact. Concealment. Failure to disclose a material fact. If that is discovered in the first 2 years, it has the effect of voiding the policy. So use your best common sense judgment as far as fraud goes. Fraud is intent to deceive. Fraud is bad. Fraud can only affect the policy if discovered during the first 2 years. If someone forgets to mention something, it's not fraud. If someone forgets to, just as bizarre as whatever it was they forgot to mention might seem like, just go with it. If someone forgets to mention something, they're not trying to commit fraud. If they intentionally conceal something, that's fraud. If it's not discovered till 5 years later, has no effect on the life insurance policy. If it's discovered during the first 2 years, then it would have an effect, the effect of voiding the policy. Collecting the initial premium and issuing conditional receipts. So this concept of an insurance policy being conditional is really important. So if you buy insurance, it's not guaranteed per se. It's conditional upon certain things, like the insured has to pay the premium. If they're going through underwriting, they have to pass a physical. So that insurance policies, life insurance policies, health insurance policies, they're conditional contracts. They're conditioned upon both the insured and the insurer doing certain things. Now, generically, we're going to discuss when can you give out what's called a conditional receipt and when can't you. And this is just very general because your insurance company is going to have certain rules about it, which you will learn once you take and pass your pre-licensing exam. So I'm not teaching you these things and saying your company is going to always follow these rules. These are just in general how we can do this. So when you meet with a client, if they seem like a good risk, they're young and they're healthy, there's no pre-existing health conditions, you think your underwriter is going to want to issue them a policy. You would want to give out what's called a conditional receipt. You would never give out a conditional receipt without collecting the client's first premium payment. It's a receipt for the premium that was paid. So you take their premium payment, you take the application, give them a conditional receipt. Let's say you did this on 3/1. So application taken, premium paid, conditional receipt given. When is the person covered? I don't know. When the conditions are satisfied. So it's this very gray term. It's this idea that every person, every client, potentially could have a different condition. The earliest the coverage will take effect is as of date of application. That's only when there are no conditions to satisfy. And that's very rare. In very young children, there's no conditions to satisfy. But every other individual life insurance policy that you purchase, generally there are conditions to satisfy. So coverage is effective when the conditions are satisfied at earliest date of application. So this is the earliest. Only if there are no conditions. So if there are no conditions, coverage is effective as of date of application. What if there's a condition? A common condition is for the insured, the proposed insured, to have to pass a physical exam. So 3/1, application taken, premium paid, conditional receipt given. Application taken, premium paid, conditional receipt given. On 3/10, the client goes to the doctor and passes a physical. The question is, what is the effective date of coverage? Anytime the question says that they go to the doctor and pass a physical, that is the implied condition. So they might word it like this. When you give out a conditional receipt, coverage is effective either date of application or when they pass a physical, whichever is later. Okay, so I need to make sure that that makes sense for you. If passing a physical is ever part of the question, that's the implied condition. Coverage is effective when the physical exam has been passed. Now, in the previous example, we said 3-1, money taken, application taken, conditional receipt was given, and that there were no conditions to satisfy. So if there is no conditions to satisfy, coverage is effective as of date of application. That is the earliest it could ever be effective. But then they sometimes word it like this, which just don't miss this question. When you give out a conditional receipt, when is coverage effective? Date of application or when they pass a physical? When they pass a physical. Whichever of these two events is later, okay? So generally speaking, application is done first, premium is paid first, conditional receipt is given, then they go and they pass a physical. That's the effective date of coverage. When's the free look start? Policy delivery. Policy delivery. So it's entirely possible that if you don't get around to delivering the policy for 6 months, this person has had coverage in this example from 3/10 forward. If you deliver the policy July 1st and they want to exercise their free look, they can get all of their money back. If they died in this question on 3/20, they're covered. They're covered as of the effective date. Incontestability clause starts as of the effective date of coverage. Suicide clause starts as of the effective date of coverage. When does the free look start? Policy delivery. So be careful. Those are things that they like to trick you up on. So coverage begins at earliest the date of application or when the client passes a physical, whichever is later. Sometimes your client doesn't seem to be such a good risk, and you think to yourself, I better not give out a conditional receipt. I don't want them to think that they're conditionally covered. So you do what's called a COD submittal application. COD stands for collect on delivery. So COD submittal application so you take their application. Let's say you did this on April 1st, application taken. You're really not sure what kind of a risk they're going to be, but you don't think that they're going to be a standard risk or a preferred risk. They're probably going to have to pay more. They've had heart surgeries. You really hope you can sell it, but you're not sure really yet. So you take the application and you send it on to your insurance company's underwriter, who looks over the application and on 5/10 decides that they are ready to issue a policy. So this person they've decided is a substandard risk. They're going to have to pay a lot. The underwriter issues the policy. Is it effective yet? No way. Why? What have we not gotten from the client? Money. You got to get the money. So we're the producer, we get the policy, we go back to the client. Why is it so important to, as soon as we get the policy, go back to the client? Well, there's a couple of things. They have no coverage because they haven't paid a premium yet. And, they might really need the coverage. So you take the policy, you explain it to the client. You're going to have to pay more because of your previous conditions. Or it might be the case that the insurance company's decided to exclude the heart condition. So if the person dies from a heart-related illness, it's not covered at all. Sometimes insurance companies will add an exclusion for something, or maybe they just try to charge more money for it. That's a good rule for the test. Always try to collect more money from your client first. Then if the client says, no way, I can't afford that, then the insurance company will add an exclusion for something like their heart condition. The last thing you'd ever want to do is deny the policy. So the insurance company is always going to try to get as much money out of the client as they possibly can. So we go back to the client. We explain to them the policy, what it's covering, and we have to collect some money. So we got to get the money, and we collect the money. But we also have to get what's called a statement of good health. So a statement of continued good health. Continued good health. So the underwriter had decided that they were ready to issue a policy based upon the risk, but the policy's not effective until we actually collect the money from the client and we get from them a statement of good health. If you go back to this client's house and the wife answers the door and she says, "Oh, I'm so sorry, you just missed him. He's back in the ICU. You had another heart issue." What are you going to do? Are you going to take her money really quick and run? No. If the health has changed at all, if they can't, in good conscience, sign a statement of continued good health, then you can't issue the policy the way that it stands. So in that case, send it back to the underwriter, tell them, they're sick again, what do you want us to do? If they will attest, so you, the producer, do not sign the statement of good health. The client signs the statement of good health. They pay you a premium. Coverage is effective as of, in this example, 5/20. So you deliver the policy here, 5/20. Collect their money, 5/20. Statement of good health, 5/20. Free look starts here. Incontestability clause starts here. Suicide clause starts here. Because in a COD submittal application situation, you're delivering the policy at the same time that you get the premium payments. We never use binders in life and health insurance. The ability to bind coverage is a property and casualty topic. So if you ever see binders for life insurance, they're never the right answer, meaning you can't bind coverage. Life insurance policies are conditional. No unconditional coverage ever, so no binders. There are certain requirements to protect applicants' health information. So we have HIPAA regulations. You need to know what are HIPAA regulations designed to protect. They are designed to protect a client's health information, not their financial information. HIPAA is designed to protect the client's, the applicant's, the insured's health information. So as part of the HIPAA regulation, it requires privacy notices be given out to the client that describes how we're going to protect what is the protected health information. What can we share? What can't we share? What can we do with your information? So the privacy rule protects all individually identifiable health information. Always a test question. Protected health information includes all of your health history, your name, your address, your social security number, and your birth date. So HIPAA rules protect health information, not financial information. Different rules protect financial information beyond the scope of this test. HIPAA is just for health, just for your health information. Sometimes when you buy life insurance, you're required to pass an HIV test. They can never do that test without the applicant's prior written informed consent, and all test results may only be released to the applicant's physician. Always a test question. Test results can only be released to the applicant's doctor. Same thing with any information that is collected on you by the MIB. The MIB is the Medical Information Bureau. Everything on there is tied to you. It's all your health data tied to you by social security number. MIB information, meaning it's not public record. The agent doesn't know about it. The producer doesn't know about it. Agent and producer, they'll use those terms interchangeably. The applicant's doctor is the only one that, because it's this protected information, your health history. It's not public information. Credit report. So sometimes insurance companies underwrite using credit and sometimes they don't. It really depends upon the state law and the underwriting standards of the insurance company. It is perfectly legal to underwrite using credit if you follow the Federal Fair Credit Reporting Act, which says that you can't pull someone's credit without their prior written informed consent. It's usually part of the application process where we tell the client that in connection with this application, we may pull your credit. You have to tell them in advance. After 9/11, the USA Patriot Act was enacted, which is designed to help financial institutions file certain reports so that we can detect money laundering. So the USA Patriot Act was a law that was enacted after 9/11. You absolutely must know that. designed to increase our ability to prevent, detect, and prosecute international money laundering and the financing of terrorism. So that's not hard to forget. Terrorism, 9/11. It requires that all financial institutions file what's called a CTR, which is a currency transaction report, with FinCEN, which is a division of the Treasury Department, for each cash transaction that exceeds $10,000. This applies to the transfer of funds electronically, the purchases of certificates of deposit, stocks, bonds, and other investments. So a currency transaction report is created each time there is a transaction that's over $10,000. It also requires the reporting of wire transfers in excess of $3,000. So it's one of the things that happened after 9/11. Insurable interest, finally. I know I've mentioned it already throughout the course. It is such an important topic for life insurance. So you already know, insurable interest must exist when? At time of application. You have it in yourself, family members, and key people in your business. So key person or a business partner. You can't just buy insurance on whoever you think is going to die today. Otherwise, you'd be hanging out in the long-term care facilities and, no, you can't do that. So you only have to have insurable interest at time of application, not at reinstatement, just at time of application. When the insurance company asks that an applicant fill out the application and give health history, they know people are going to lie. So that's when they check the MIB. So the MIB, the Medical Information Bureau, this is your health history tied to you by Social Security number. So, you forgot to mention that surgery you had, and you go, yeah, I forgot. Or whatever the case may be. Now remember, just like your credit report, your MIB report might be wrong. You can always request a copy online. You can do that. The data contained in your MIB report, who can that be released to? Your doctor. So if you are the applicant, the information in your MIB report can only be disclosed to the applicant's doctor. I had a student who said he was buying life insurance, and every time they pulled his MIB, it said he went to alcohol rehab, and he swore. He said, I didn't, I swear, And it was on his MIB erroneously, so I had to get it fixed. We talked about the Federal Fair Credit Reporting Act requires written pre-notification, and it also says that if they decide to not issue a policy, and part of the reason is because of your credit score, they have to tell you which consumer reporting agency was used. You now, as the consumer, have a right to request a copy of your credit report for free. So they'll use the term on the test, consumer report, or maybe they'll use investigative report. It's all the same thing. It's all under the Fair Credit Reporting Act. Risk classification. So everyday average Joe is going to be what we call a standard risk. They're what the mortality table was developed for, the normal everyday average risk. If someone is really healthy, doesn't have any pre-existing health conditions, don't smoke, don't drink, exercise all the time, we expect they're going to live a long time. So for life insurance, we'll charge them a preferred rate. So they'll get a discount from the standard rate. If someone does have poor health, or maybe they have lots of hazardous hobbies, they have lots of avocations that are dangerous, then we're going to charge them more than normal. That's called a substandard or non-standard rate, where they pay more than the average person would have to pay. So let me ask you, is age an underwriting factor for life insurance? Well, sure, right? The older we get, the closer we are to dying, every day. It's just how life works. How about gender? Is that an allowable underwriting factor for life insurance? Sure. Statistically speaking, women live longer than men. How about this one? Marital status. Think about it. Do you know? Married people, there's no statistical evidence that married people will live longer or maybe not as long. No, marital status is not an allowable underwriting factor for life insurance. I bet you hadn't thought about that. So be careful, the test likes that. Marital status is not an allowable underwriting factor for life insurance. What are some other things that the underwriter will look at? Will they care what your occupation is? Sure. Your avocation, your hobbies, yes. So occupation we sometimes call vocation. Avocation, those are the things you do outside of work, like you ride your mountain bike, or you go surfing in the ocean with the sharks, or you like to jump out of airplanes, which I would never do. Age, gender, smoker, non-smoker, of course, matters. Your height and weight matters. Health factors matter, but not marital status. Stranger-originated life insurance and investor-originated life insurance. These are interesting policies where some states actually will prohibit them by law. It's this idea that, let's see, there's two ways that this can work. These are weird, and the main problem with these is, well, let me think about your life. Do you own life insurance on anyone? You have life insurance on yourself. You have life insurance on your spouse. What they found was happening is down in Florida, there were these companies that were groups of investors, and they were inviting older people on cruises, free cruises, if the older people would agree to let these investors have them go through a physical exam on the cruise ship and let them buy life insurance on them. What? Life insurance on a stranger? That's not normal. So the test definitely wants you to understand that investor-owned life insurance, stranger-owned life insurance, not policies that we want to have occurring on a regular basis. They're relatively new problems, if you will, so that some states have adopted laws against them and some states have not. But this concept of owning insurance on someone that you have no insurable interest in, so that if you did do this, let's say you were an investor in one of these and you have this policy on this 70-year-old lady that lives in New York City. So here you are as the investor. What do you want to have happen? What do you want her to do? You want her to die so that you can get the money from her. That's just wrong. So that's the main point for these policies. Stranger-originated life insurance, investor-originated life insurance violate the idea of having insurable interest. So that what's happening, some of them that were purchased when the person does finally die and the investor's waiting to get paid, the insurance companies are saying, no, we don't want to pay. So it's going to be interesting over the years how it all plays out. Know what the main problem is. This idea that the owner does not have insurable interest. And then we'll just leave it at that. Because whether or not it's allowed by your state really does just depend upon what state you're in, and that's a whole nother part of the course. Delivering the policy. Coverage will begin when all conditions have been satisfied or when the underwriter approves the application, whichever occurs first. So coverage begins when the conditions are satisfied, we said that, or when the underwriter approves the application, whichever occurs first. There's never any coverage unless a valid premium has been paid, so we know that. Offer and acceptance must also occur. So offer and acceptance are a mutual agreement of the parties. Offer and acceptance, a meeting of the minds. So in order to have a legal contract, there's an acronym and it goes like this, COAL, C-O-A-L. The C we've already talked about, and this was consideration. Consideration clause, the exchange of value. Offer and acceptance, this is mutual agreement of the minds. So sometimes the insurance company makes a counter offer, so say they added an exclusion. Whenever the insurance company makes a counter offer, it is the insured's, the applicant's responsibility to say yes or no, accept the counter offer or not. So sometimes it will go around more than once. The producer signs the application but is not a party to the contract. That's usually a concept you need to feel comfortable with. If you, the producer, sell life insurance to a client, when the client dies, you don't owe any money. It's the contract itself is between the owner and the insurance company. They like on the test this idea. If you could call your client or see your client in person, always go and see your client. Always. If your client has insurance with you but wants to buy more insurance, should you just send them the application? No. Go and see your client. It's always the right answer on the test. Especially when you have done COD submittal application, you have to go to the client, explain the policy, collect the money, get the statement of good health, because there's no coverage until you do so. So always go see your client, explain everything you can. The more they understand the policy, the less likely they are to call you up and ask you questions about it in the future. And the more they understand of the policy, the more likely they are to actually pay for it. It's an interesting thing that if we understand how the policy protects our family, we don't mind paying for it anymore. So always see the client in person. That concludes our discussion for the application, underwriting, and policy delivery. Make sure you read your key facts.